What's going on, guys? What's going on? Good evening. Good evening. I just want to come on here briefly and talk to you guys why it's important to put your money in hard assets like real estate. All the major gurus talk about it. I don't want to say gurus, but all your real estate, financial, stable people like as far as like Robert Kiyosaki, Grant Cardone, Boyce Watkins, Jay Morrison, like all these guys who you may see on social media, they always preach put your money in hard assets. Your money in banks, guys, is not doing you anything. Getting you a return of 0.002, whatever what banks pay you, is not the way to go, guys. You can get way more. You can get a return of 15% on your money if you invest it right into real estate, guys. If you just invest it correctly. Look what happened with this whole recession things and the Feds raising interest rates half or basis points has pretty much caused this collapse in Silicon Valley Bank. And this isn't the only bank that has collapsed. I mean, something happened in 2008. Also, the same thing. So I just want to get into this article real quick. I'm going to be briefly and just talk about again why real estate and put your money in hard assets is the way to go. So you won't have to be like these people out here standing outside of the bank wanting to get their deposits because they're not going to get their deposit. If they have more than 250,000 in their bank, it's probably going to be a long time before they even see that money, guys. Seriously, because the FDIC only insures your money up to 250,000. So if you have more than 250,000, you may want to split your money up in different banks and maybe bigger banks. You know, there's nothing wrong with small banks because small banks do a great job of helping people out, small businesses, giving loans, home equity lines of credit. They are one of the best people to lend from. So, but unfortunately, things like this happen, guys. And I don't know how Silicon Valley Bank didn't see it, because the Feds clearly were saying that they want to raise interest rates. Maybe they didn't believe them, you know. So, but this article, this New York Times article, talks about on Friday, Silicon Valley Bank, a lender to some of the biggest names in the technology world, became the largest bank to fail since the 2008 financial crisis. We all know 2008 was a very, very significant year. Um, for the same reason that lender banks were lending to people who couldn't even afford the loans, and it uh, turned into a tornado where foreclosures were out of nowhere. So, and the same thing happened. So, a lot of people think this may be like 2008, but let's continue. So, by Sunday night, regulators had abruptly shut down Signature Bank to prevent a crisis in the broader banking system. The bank's swift closures have sent shockwaves through the tech industry, Wall Street, and Washington. Here's what we know about the developing story. So they asked the question, why did Silicon Valley fail? This is very important, guys. This is very significant right here. Let me make this a little bit bigger. Um, they asked the question, how did Silicon Valley fail? That's the question. So here they say Silicon Valley Bank provided banking services to nearly half the country's venture capital backed technology and life science companies, according to his website, to more than 2,500 venture capital firms. So we know Silicon Valley is a tech area in California where there's startup tech companies, very very wealthy people in this area, and they've lended to a lot of these small businesses, these tech companies, who probably were millionaires. So they held money for these startup these tech companies. Um, but unfortunately, it just wasn't the right move. No one. I mean, I'm pretty sure some people saw it coming. Some people saw it coming, just like Michael Berry, the Big Short, when he shorted the market the other day because he saw it coming. So here the article continues to say, for decades, Silicon Valley Bank, flushed with cash from high flying startups, did what most of its rivals do. It kept a small chunk of its deposits in cash and it used the rest to buy long term debt like treasury bonds. So why do banks buy treasury bonds, guys? So first, ask yourself, what is a treasury bond? A treasury bond is pretty much a U.S. backed government bond, or a treasury bond is also called a government bond, and it's a type of fixed income security that is issued by the U.S. Treasury Department to raise funds for the government various expenses. Pretty much the government is taking your money and saying they're going to pay you back with interest. So the government can take care of their expenses. People do that when they feel like it's a safe way to put your money somewhere while you may feel like the temperature of the economy may not be where you want to be. So people invest in treasury bonds. So in simpler terms, it's a loan that you make to the government, where the government promises to pay you back the principal amount with interest over a specified period of time. Treasury bonds are considered maybe one of the safest investments because they are backed by the full faith of the credit of the U.S. government. So that's pretty much what treasury bonds are, guys. So how did Silicon Valley get in trouble? This is how they got in trouble. Let's continue. Before we get into that, I want to finish reading this. So for decades, Silicon Valley flushed with cash from high-flying startups and what most of its rivals do. Most they pretty much operate like other banks did. It kept a small chunk of its deposits in cash, and it used the rest to buy long-term debt like treasury bonds. Well, I just told you guys what the treasury bonds were. So here it says those investments promise steady, modest returns when the interest rates remain low. So treasury bonds, according to the New York Times, are a good instrument to buy when rates are low. But are rates low now, guys? They're not. So let's see how Silicon Valley got in trouble. Let's continue. But they were in turn short sighted. They were short sighted. The bank hadn't considered what was happening in the broader economy, which was overheated after more than a year of pandemic stimulus. So the government during the pandemic kept pumping money out, saving small businesses. Me myself, I own. I'm a small business owner. So I got money for that. So the government gave me money. So they were pumping money out, guys. So Silicon Valley, when that happens, guys, when you pump more money out than allegedly is backed by gold, you pretty much just it's fake money. So that causes inflation, guys. People are spending like crazy, and that's not what the Fed wants. So pretty much the Fed calls, just to be honest. So here, the New York Times said that meant that Silicon Valley Bank was left in alerts when the Federal Reserve, looking to combat rapid inflation, started raising interest rates. Those once safe investments looked a lot less attractive as newer government bonds kicked up more interest. But not all Silicon Valley banks are linked to rising interest rates. So now rates is rise. So now you have new Treasury bonds, guys, that the government is issuing. So those bonds that Silicon Valley held weren't as attractive as the bonds that came out now. So that's what the issue was. So now they have to, when their investors want their money back, they have to sell these bonds because they don't have the cash. They invested their cash. The banks invest your money, guys. That money's just not sitting in some like they're not like a guard dog or a security guard, or you just can put your money there and they're just gonna like sit and watch your money till you want to take it out. No, they invest your money. You give them 100,000, they take your 100,000, invest it in the bond or whatever, make 2 million, they give your 100,000 back, while they make 2 million off you. That's America for you, huh? So, so pretty much what happened was okay. So let someone may ask a question: how does interest rates affect the Treasury bond? So Jerome Powell raised interest rates. So this is what happened. This is how Silicon Valley got in trouble. So pretty much interest rates have a significant effect on price and yield of Treasury bonds. So when interest rates rise, guys, the price of the existing bonds decreases. So pay attention. This is how they got in trouble, guys. This is how Silicon Valley got in trouble because they bought them bonds that were worth less than the newer bonds because the interest rates rose. So now you have bonds who give a more higher return, but Silicon Valley already bought earlier bonds at a lower rate. So interest rates have a significant effect on price and yield of treasury bonds. Remember I said that, guys. So when interest rates rise and Jerome Powell rose the rates, the price of existing bonds decreases and their yield increase become more attractive to potential investors. So this only happens because new bonds, guys, like the New York Times just said. So this happens because new bonds issued at a higher interest rate will offer more attractive returns than older bonds with lower interest rates. So the newer bonds are more attractive, guys. So now that these clients of the bank, they want their money, but the bank, like I said earlier, the bank does not have their money. So what they have to do, they have to sell the bonds. They have to sell their investment instrument, but they sell it not at a profit. So they took a loss. They took a loss. So this is how they got in trouble, guys. So on the flip side, when interest rates fall, which happened during the pandemic, which that's when Silicon Valley bought. When interest rates fall, the price of existing bonds increases and their yield decreases as they become less attractive to potential investors. This happens because new bonds issued at a lower interest rate will offer less attractive returns than older bonds with higher interest rates. So you guys get that. So the treasury bonds are often considered a benchmark to gauge the overall interest rate environment. When market interest rates rise, the yield on treasury bonds typically follow suit, making those bonds more attractive to investors. Conversely, when market interest rates fall, the yield on treasury bonds may also fall. So this is where Silicon Valley got into trouble, guys. I hope you guys understood this. It's late. I'm tired. But this is why you put your money in real estate, guys. This is why you put your money into hard assets like real estate, guys. 100,000. You put 100,000 down payment on $1 million building, guys. Rent them things out. Get yourself a cash so 12, 13, 14%. You're good. People always have to find a place to live. You wouldn't have to worry about where your money. Can you get your money out the bank? Because Silicon Valley went under. Them people with money over had with cash deposit over 250,000 in that bank are going to be waiting for a long time, guys. The Treasury Janet Yellen, she said they're not going to bail them out, but I don't believe them. They're going to bail them out. I believe, me personally, I believe they're going to bail them out. That's just me personally. So if you guys want to check out the New York Times, guys, read this article. It's very interesting, guys. I just wanted to stop through, let you guys know why it's very important, guys, to invest in hard assets like real estate, so you guys won't have to deal with things like this. Park your money, like Robert Kiyosaki said in Rich Dad Poor Dad. Park your money into hard assets. You have a better chance of investing 100,000 in a 10 unit apartment building, and over a 5 year span grow that equity to maybe 400,000. Your money would never do that in the bank. Never, never. It would never do that in the bank. Never. So guys, if you don't know anything about real estate, learn. YouTube. Go to the University of YouTube. Go to the University of YouTube, guys. It's there for you. You can teach. I got a couple of videos up. I work a lot, guys. I'm gonna start dropping more videos, guys, to give you the information that I know to help you guys out. You know. Again, guys, don't be afraid. Remember this: an uncertain mind is just waiting to be taken over by a definite mind. What do I mean by that? See, an uncertain mind loves a 9 to 5. He's uncertain. He feel comfortable. He's uncertain in himself. But one thing that he knows, if he gets up at 9, is going to feed him. His boss is going to feed him. That boss is the person with the definite mind. He has a goal in mind. He has a plan. He knows what he wants. He's not afraid to take risk. So if you're an uncertain person, trust me, a person with a definite mind will take over your life. You can't be satisfied getting up at 9 and knowing for sure you're gonna get up at 5 and get caught up in that type of monotony. Break free from the chains. Break free from the plantation, guys. And I'm out. Have a good night. And it's not get rich quick. It's get rich for show.